Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are live coming to you from Excell in Nashville. This is the 52nd episode of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, we're calling this one the Megapod.
Megapod, and that's because we've never had 5 people. I don't think we've ever had 4, maybe, but 5. We have some special guests today.
I see. There it is. We're on Twitter. We are live on Twitter, guys.
Right.
We are
it's
really
official.
That's
X.
good. I wanted to see that.
X.
He always slaps me. That's right. It's X. It's X. I mean,
X.
honestly, maybe let's just go through the line. I know who you are, but your name, company, real fast, and we're going to get into it. But start with Frank there.
Sure. Thank you very much for having us. And Frank Cappelleri from CappThesis, technical analysis research firm, about a year old. So very excited to be here with my friends.
Mm-hmm. Hey, this is Paul Hickey from Bespoke Investment Group. We're based out of New York, and very happy to be in Nashville and part of the Excell Conference and the Facts versus Feelings podcast.
And I'm Sam Rowe. I write the Ticker newsletter. It's curated news, data, and insights for long-term investors.
And Sam is a repeat offender, if you will.
Yeah,
You're
that's my second
future-proof this week, and now you're here now, so traveling the world. Let's start with a little fun, because, it's the third day of this conference. We're a little tired. Or is it true, Sam, that you're going to wait 2 hours in line to eat at Hattie B's later today? And tell people what Hattie B's is if they don't know.
Yes.
Let's start with
All right.
that.
So I have some in-laws in town and we're going to get dinner a little later, and they recommended we give Hattie B's a shot because, Nashville hot chicken.
Yep.
It's worth it.
Yeah, it's worth it, and who doesn't love fried chicken? But on my way over to here, I actually walked by it, and it's 2:30 in the afternoon on a Thursday, and there's already a line around the corner for that restaurant. So I don't know if we're gonna make it, but we'll give it a shot.
I went by there for lunch and waited 15 minutes, didn't move, and came back.
Well, Paul, let's go to you. I mean, by the way, huge fans of all three of you. I mean, been following you guys for years, and there's a reason we wanted to have you here. I mean, Paul, with Bespoke, you guys look at so much data and do so many cool things. I mean, let's talk about that. This city is crazy. I mean, Monday night, Broadway, you couldn't move. I mean, it doesn't feel like a recession to me. Everyone's talking about recession or not. There's no recession in Nashville. With the data you guys all look at, how strong is the economy? Or weak is the economy? Let's talk about the economy for a minute.
So, I mean, it's funny you say that. I was thinking the same thing last night. Every bar packed. There's a band in every floor of every bar. It's amazing. When we look at the economy right now, the Doors released the album Strange Days 56 years ago next week. And when you look at the economy, you can look at different aspects of it and find that you can make an exceptional case that we're about to fall into a recession. You can make a great case that the economy is doing just fine. And you can even make a case that we're sort of early cycle in rebounding. So when you look at all these different factors, it's a very difficult situation for investors and professional or retail alike to make sense of. But the key is, and it's one of our main messages that we focus on and tell to clients, is to listen to the market. And the title of your podcast, Facts versus Feelings, is a great one because so many people think, get caught up in the emotion of the markets and they don't focus on what's going on. And when you look at the facts, more of them point to an economy doing okay rather than an economy falling off a cliff.
So I think this is how we do this. We just wing it. How about I'll go 3 and then you go 3? How's that sound? So I was going down the line. So the message of the market, Frank, there's no, in my opinion, there's virtually no better technician in the world than Frank. Been following you for years. What is the message of the market? I'm just going to give you a lob. I mean, take this however you want to go. What are some things you're seeing from a technical point of view, Frank, that you think listeners, and take note, everybody really, if you don't know, a lot of advisors listen to this podcast. A lot of younger people and advisors listen to this. But take it away, Frank. What do you hear in the message of the market from a technical point of view?
Well, I think you have to have a stance, and stance, from my perspective, is based on trend. It's an uptrend. That's a fact, not a feeling, number one. And so I base those facts on what creates an uptrend. Well, from my perspective, two key things. You have to have bullish patterns that work, right? And you have to have low volatility. Now, bullish patterns started to work, and there had to be lower volatility really starting in the second quarter, from my perspective. And that's when things really, you started seeing bullish patterns work. When I say that, meaning that you saw the breakout zones were not violated and eventually have an upside target hit. So that sometimes takes some time to play out. But really what the first indication was that when I say volatility, not really by the traditional measurement of the VIX, because the VIX misses one key thing. It does not measure upside volatility, right? When markets crash, VIX goes higher, but as you know, the most amount of big moves on the upside come in downtrends as well. So you go back to really 2022, we knew that there's 130 just about plus or minus 1% moves that year, and just as many to the upside and downside. That actually persisted all the way through the October low into the first quarter of this year. And then really, when April started, it just went away. And so since that point, we've had only 18. So it comes out to about 3 or 4 a month compared to 10 or 11 a month. So it doesn't sound like much, but what happens when smaller moves happen? That means that there's less, again, volatility intraday as well. Volume drops, it gets boring. Boring market lends to having breakouts work, right? So a long-winded way of saying that, so since that breakout in April, we've had 4 different S&P targets hit in a row, which is not rare, but you know what's happened before? It's happened in 2019, 2017, 2013, right? All, and actually 21 as well. All uptrends, but persistent uptrends. So that gets us to the beginning of August. As we know, that had bearish seasonality, but it so happened that we'd run out of bullish patterns at that point. So my perspective, we needed the market to come in at that point to establish another foundation. And really, if you think about it, that's happened now the past 6 or 7 weeks. What's happened from that point? We have the low in August and now potentially higher low, which we could see a potential breakout, starting the fourth quarter, which then would tie into positive seasonality. And I'm sure, Paul and Ryan put out great stats to tell us the first 6 months of the year typically have a good year end. And when all that ties together, breakouts, seasonality, and stats, that's when I can get more confident that breakouts continue to work.
And you're talking about the broad market, so going into, let's talk a piece of the market, energy seems to be breaking out. What do you like better, energy or tech right now? Not to put you on the spot.
No, that's what we're here for.
You're on the
right?
spot.
You're on the spot, right. I think energy has a bigger base to come out of it. And again, that's one of the things that Ryan and I are both exchanging tweets and information recently. So when you see the stats line up with the charts, right? So, this is a breakout, but it took a while to happen, right? Energy has been, back and forth for a long time. It was just up 7 straight weeks, right? But finally pull back in bigger picture, there's like a 4 or 5 month or even longer, breakout coming in. You have to really pull back though. I would say short term, pretty extended, but if you look at energy or some of the ETFs go 3 or 4 years back, they continue to take advantage of those bases. I think will be okay.
Speaking of energy, Paul, the other side of energy breaking out is consumers don't like higher energy prices or higher gas prices, right? Is that a big reason why sentiment is poor, despite everyone's out spending?
Yeah, so I mean, it's funny because if you look at sentiment over the last year or two, it's been very weak for the type of bull market we're in. And we just actually put out a report today looking at you look at President Biden, they said he has the lowest approval rating of any president.
Don't get us in trouble talking politics, Paul. What are you doing? What are you doing here?
But don't worry, there's more to the story here.
Good,
so
good.
The lowest, and the only one who was, the second lowest was Trump, and the third lowest was Obama at this point in their presidency. So we've become very polarized. But to the point about consumer sentiment is presidential approval ratings. If consumers aren't happy, they're not going to like what's going on in Washington. And the most correlated aspect of the presidential is not employment, whether or not people are employed, it's inflation, what inflation's doing. So when you have high levels of inflation, it causes consumers to be, in a dour mood like they are now. So I think that the higher energy prices are a problem
And for everyone, inflation means gas prices.
Yes,
Pretty
it's even Powell mentioned it last year. That was a big, it's funny when you go back to the Fed policy. Last year it was focus on the headline. Then it became, when the headline started falling, it became focus on the core. So now the core is starting to decline and the headline's going up. So we'll see what the focus becomes of the Fed. But to sum it all up, I think yes, higher energy prices are great for the energy sector, but they're not good for anyone else.
But we've also learned from the last 2 years that just because sentiment is poor doesn't mean that people will actually stop spending.
And Sam, you wrote about that this morning.
Sure.
You said, once again, people seem surprised by the strength of the American consumer. Right?
Yeah.
I'm surprised. Again.
For sure.
Like,
I mean, I think Paul mentioned it in his sort of opening statement about, the feelings, right? The title of the show, Facts versus Feelings, right? There are a lot of different ways to measure this, but we do know that there has been kind of a divergence between the hard, measurable, quantifiable data versus the soft, sentiment-oriented data. How do you feel versus what are you actually doing? The hard data has been holding up, whereas the sentiment data has been, pretty poor. And so, everyone watches the news, everyone hears about, inflation and gas prices, and sure, it's easy to, sort of get bummed out about that. But, sometimes people tend to, or what we're learning as consumers, whether they like it or not, or whether they recognize it or not, they do have a little bit more money in their bank accounts, and they're going out, they're spending, they're going to Hattie B's. The August retail sales report just told us that, restaurant and bar sales are still positive. Not to completely dismiss the importance of sentiment. There are very important sociological implications. There are obviously political implications, but from a market standpoint, from an investment standpoint, investors' standpoint, who I tend to be a fundamentals type of guy. From an investment perspective, it seems pretty favorable that the hard data continues to hold up.
And Ryan, we talk politics, and so I just want to, we tell people, if you look at the consumer sentiment polls, when a Republican's in office, Democrats are less positive, vice versa. Turn off the cable news, okay? Fox News, MSNBC.
Unless we're on. Unless one of us are on TV, then
Fox
you can
News,
watch it.
Business news isn't, but they're trying to play on your emotions in the mainstream news. If you, so you look at market performance, going back to Eisenhower, if you'd invested $1,000 in the market in 1953 and only stayed invested when a Republican was in office, you'd have $27,000 today. If you only stayed invested when a Democrat was in office, you'd have $57,000 or $52,000. If you just stayed invested the whole time, $1.4 million.
Incredible.
So just
That's a mic drop.
So
That's the end of the show.
So just stay. You want to stay invested. Don't let your feelings get in the way of it. I mean, baseball has shown us Moneyball. Scouts used to always say, "I got a gut. This guy's going to be good." Don't go with your gut. You go with the facts. You go with the data and what that's telling you.
That's great.
Nice price action, it sounds like.
Exactly. Yeah, follow price action. So
we
Sam,
were just talking to Cliff about, how hard it is to go against your gut.
Yeah, we just did this with Cliff Asness, which will be a future episode of the Facts versus Feelings, but that is exactly right. Sam, I'm going to go back to you for a second. So this has been a long couple weeks getting ready for this conference. I've done like 6 of these. I've had a blast. This is my last one, so thankfully I'm feeling good about that. Next week, I'm going to take a couple days off. I'm going to go to Louisville. Do you know anything about Louisville?
I'm from Louisville.
Yeah, the Louder Than Life concert. I like rock and roll, so I'm going to go there for a day or two, just kind of get a break from all of this. But let's get into what I love saying what you do. You read all these reports, so I don't have to. Like all the Goldman reports and all of them. There was one, and I'm going to paraphrase this. You know where I'm going with it, though. There was a table or chart that you shared maybe a week or two ago that talked about debt and how 48% S&P 500 companies have financed debt, locked it in, like 2030 going forward. So what I want to get at is rates are higher. Everybody's worried. Talk to me about, well, maybe corporate America was smart and took advantage of those historically low rates, and it's really not impacting them as much going forward, because I don't think most people realize this.
Sure. I don't know if they were smart or if they were lucky, but whatever it is, they got something right this time. And one thing that they did get right was a lot of big companies who finance through the debt markets did a lot of refinancing over the past 2.5 years while rates were still pretty low. And so, as we're watching, the Fed hike rates and market interest rates increase, that has yet to translate into higher interest costs for these corporations. And this is, it's measurable. You can see it in the income statements of all these companies. But yeah, that Goldman report from a couple of weeks ago. I mean, there's a couple of different ways you can slice it. Like some people will tell you that, well, there is still kind of a wall coming up in the next couple of years. But the bottom line is, for the vast majority of companies, the issue of higher interest rates doesn't really become a problem for at least a couple of years. In which case, when those bills do come due, they at least have a little bit of time to maneuver before having to address that. And one more thing I'll note about that is even if it does translate into higher interest costs, we also have to remember that net profit margins are near record highs.
Yep.
So in many ways, they also have some room to absorb higher, financing costs, in that process. So maybe they do some refinancing, maybe they refinance at a higher rate, but they at least have some room and they have some time to absorb, what might be higher market interest rates in the years to come.
Good stuff. I've got kind of a combo question for Paul and Frank. As I was looking at you guys, I was realizing this. How long have you been in charge of Bespoke, or started Bespoke? How many years ago?
So Justin and I started it in 2007.
Okay, so a while, and Frank just started his company. So we have a lot of financial advisors that listen to this podcast. We work with financial advisors every day. They are owners of their companies. They're trying to learn how to build a company in a lot of ways. What, in your 15 years of running your own company, not necessarily for a financial advisor, but just what is something you learned that you had no idea you had to be aware of 15 years ago that you can help share with somebody so they don't have the same pain maybe that you do with the growing pains? I know Bespoke's been wildly successful, so congrats, but I'm sure you had some type of pain along the way.
I'm taking notes, by the way.
No, I mean, there's...
That's true. I mean, that's true. You're new, too. I skipped to say.
So, I mean, I think what you realize is when you do go out on your own, there's so many pros to it, but there's certainly some cons. Just office supplies, tech.
Where's the printer?
I mean, I remember
Printer's broke again.
I remember going.
Not printing again. It's too expensive.
We didn't even have a printer in our company for the first 4 years. Okay, so but it's just I remember going to the bank and taking an extra pen just so we'd have it in the office. Like these things.
Like when you're in college and you steal some toilet paper. We've all done it.
Yeah.
Sorry.
So those things, I think with any business, things are going to come up that you don't expect. I mean, I remember like certain things coming up and be like, oh shoot, we didn't think about that. But you go along with it, and you know what? If you're gonna, put in the work, you can be successful doing it. And the key piece of advice I would say is people will always say, now isn't a good time for me to do it. I should wait and do it at this time. So I remember coming home and my wife was pregnant with we had a 3-year-old, and I came home and I said, hey honey, I have some news for you. And she goes, I have some news for you too. And I go, well,
who goes first?
You go first. And she goes, I'm pregnant. And I said, oh wow. And she said,
not giving you my news.
What's your news? Exactly, Sonu. And I was like, no. And so she, and then finally she got it out of me, and she said, no, you got to go for it. There's never going to be a good time, and go for it. And I think in that respect, people supporting you, having your back, and then just knowing that there's no time like the present, as they say. It's a cliche, but that's what it is.
Well said. So Frank, you started CappThesis how long ago?
Just about a year ago.
About a year ago. So obviously you're different from there. But what have you learned in the year, kind of starting your own research shop in essence?
Yeah, well, there's a lot that goes into it, but I think that just being home, we were talking about this before, just with COVID and having everything there, it gave a little step up to actually have systems in place. But that was just a start. And so one of the first things I did was on the site is put our 10 core values. Right, it was somewhat market related, somewhat work ethic related, and just how you want to work and represent the firm. Number one was the market is always right. So that's true. But little did I realize that applied to the entire business and life in general, because you have these plans about what you think should work, and a lot of it does and some does not, but the market tells you right away. And so I think if you put your ego in front of that and say, I'm right, and you'll eventually like it, it's the wrong way to go. And so whether it's a product you put out, some kind of marketing plan, or whatever it is, you have to listen carefully and don't be afraid to make a shift that way based on what the market is telling you. Again, that could be customers, that could just be the marketplace in general.
No,
That's
great
number
stuff.
one.
I mean, guys, we've hit about the 19-minute mark, so we're about halfway done. Haven't been so bad, right? We doing okay? No one got up and left yet, at least. Yeah.
Sam, what prompted you to go go independent, basically?
Sure. Well, I took Paul's advice, and it sounded like the right time. No, it really was. It was actually a feedback that I was getting from readers and feedback that I was getting from people I meet at events like this. That there's a demand for a news experience and an information experience and a data experience that is curated and framed for people who are thinking long term, right? Whether we're aware of it or not, when you get bombarded with news, every day, with just the headlines, it's very easy to sort of, get panicked, or as you scramble to try to make sense of every little move. But sometimes, some of those developments, actually mean something for the long term, and a lot of the time it doesn't. And so basically what I try to provide is a little bit of context for all the news that we do that does get covered every day, so that people don't have to think, should I be dumping stocks today and then getting back in tomorrow? Again, sometimes it turns out that the fluctuations of the markets and economic data is just a normal part of investing for the long run.
That's one reason I love reading your writing, and I think this brings to bear recently, I think it's a couple of days ago, that Walmart announced good news.
Right.
And it's always like a double-edged sword every time, like, oh, Walmart's announced good results, or Walmart's talking good about, what their business. Is that a good thing or a bad thing, right?
Right, yeah. I mean, in fairness, it's possible to frame a lot of information, including Walmart performance, in both a positive light or negative light, and from a news perspective, you can make an argument that both ways of framing it is fair, right? When Walmart is thriving, you could come up with this theory that, well, it's because people are going broke and they can't shop at Whole Foods anymore, they can't buy designer brands anymore, and they can't do XYZ things, and they have to go down there. But if Walmart is suddenly doing poorly, then my goodness, that must be a crisis, because people can't even afford to go to Walmart anymore, right? They're spending half on groceries, and all of your underwear has holes in it now, right? So I think that
How'd you know about my underwear?
I think that was actually an
It's all the
old.
shoes.
Yeah.
I think that was actually an old Alan Greenspan thing, right? It's the underwear indicator. If there's inflation, I forget exactly how it works, but he says that if there's inflation in underwear, it signals something about the economy.
The Sam Rowe indicator. It's all about underwear. I mean, you could be famous, Sam. That's right.
That's another topic.
But yeah, no, I think it all goes to speak to how confusing things can get, and to be fair, I don't know this time around if it's a good thing or a bad thing. So whenever data becomes ambiguous or a piece of news becomes ambiguous, I have to sort of think about well, what's the other data saying, right? If you saw the consumer sentiment surveys and you saw that Walmart sales were up, you can very easily stitch this nice narrative about how everything is terrible. But then when you start to look at stuff like, checking deposit balances, you look at job creation, you look at retail sales data, you look at, personal consumption expenditures and all these other measures that are saying the consumer is healthy, that they're spending, they're going out, everyone's traveling. You guys seem to be having a pretty busy conference. Business expense budgets must be up. The balance tells me that maybe it's a bullish Walmart story instead of a bearish Walmart story.
Yeah.
Well, it used to be that, they would say when people in Greenwich start talking about how cool Walmart is, it was a bad thing. But Walmart has changed, I think, in that respect. It's an e-commerce play. So there's a whole lot of, you have to know what's changing, like you said, what matters and what doesn't matter.
Exactly, and that's the other thing too, right? It evolves over time. Everything changes over time. I mean, I don't know if you've all, I'm from New York, so we don't have a lot of Walmarts, and the Walmarts that are nearby are pretty, whatever. But, growing up in Louisville, and you travel sometimes and you go to a Walmart in a, somewhat rural area, it's pretty hot spot, man.
Let me just ask something real fast. Have you ever been to 23 Cornelia Street? You know what I'm talking about?
I don't think so.
So I was in New York. I was in New York City.
Yeah,
I was in New York last week. That's Taylor Swift's
place.
old address.
Taylor
So my
Swift's
daughter
place,
made
yeah.
me go. We took probably 500 pictures in front of this thing, and I even did a picture in front of it. So go to 23 Cornelia down there in the village. You'll I'm not saying you're going to love it. It's just quite a sight to see all the Swifties that are doing it.
Speaking of Swifty, like you mentioned a whole bunch of economic data the hard data we just talked about, everything's looking good. And you think, okay, the economy is doing pretty well. Yes, sentiment is poor, but forget sentiment, right? Let's just focus on the hard data. You think if the economy is doing well, and right now I think safe to say it's accelerated recently. Frank, why aren't small caps doing well? You think small caps, small stocks should do better during a time like this?
That's a good question.
What's happening there?
I think first we have to think about what makes up the small caps, right, in terms of sectors and groups. So the two biggest groups within the IWM small cap ETF, regional banks and biotech, right? So looking at what those have been doing, you can understand why small caps overall. So if you look at just a chart of that, the IWM looks very similar to the KRE regional bank ETF, right? And so it looks, if you look at that right now, they both look like mini tops, right, over the last few weeks to months. However, if you pull that back all the way to last year, the IWM, this is the third time we've seen a top information form. So, and people every time when that has happened, get that kind of question. What are they doing? Why, it's not performing and it's bad breath, so forth and so on. But what's happened is that just when those bearish patterns are about to roll over, that's when demand comes back into the picture. And so
IWM's up 1.5% as we speak, and I know it's flirting with that 200-day, right? It's flirting right at that 200-day. You want to talk about that, maybe?
Open right now?
I don't even know what day it is. Like,
I'm still in California.
It was Tuesday. Okay, some guy walked by me and said something like, "It's Tuesday." I honest to God thought it was Monday. Getting ready for this conference has been crazy. But anyway, big jump out of small caps right now. And I'm with you. I think it's a level they should bounce,
right.
And they apparently
And
are
we've
right
liked it
now.
for a while,
We're
right.
overweight small caps, so we hope Frank can tell us we're right here. Yeah.
Well, that's the point, though, I think, because it depends on the time horizon that you look at right now. And I think because of everyone, we're talking about the news and so forth and so on, it gives a false sense of alarm, right? And if you pull that back, 200-day moving average is a good one. Of course, it's moving higher. That could be support at times. Overall, though, we're still making higher lows. So as long as you see demand come in when those happen, that's a key. And so just the other day, when I put out something on Twitter, sometimes it gets some attention, some not. One blew up over the last few weeks, and that was showing the S&P's crystal clear bearish pattern that everyone was talking about. And I love looking at that as well, but I get a little hesitant when all of Twitter's mentioning it. So all I did was put in a picture of that and a picture of what it looked like in March, right before the bounce, and it was basically a fake out. That got a lot of debate here and there, but it gave me a sense of, all right, let's pull back and see what happens. I'm going to not assume, but take the other side and be like, maybe this is not going to turn out. So the bottom line is, when something is showing a very large formation, there's a tendency sometimes to not work out, and then you have a big reversal on the other side.
Got it. So everyone, this is the 52nd, right? 52nd? I think it's 52nd.
52,
52nd episode of Carson's Facts versus Feelings, coming to you live from the Excell Conference in Nashville. I'm going to give all three of you the same question, so we can start with Sam and go on down. I want to give you guys some time to talk about what you do, how you can help investors, how you can help advisors, a little bit about your company, how we can follow you and learn more about you. So Sam, go ahead and just go on down the line. Brag a little bit. And let me preface this. I probably read 10 things religiously. You three are, your three are out of the 10.
Yeah.
We
There's a
we get
reason.
your stuff, and we
You three
love
are here.
all three
Appreciate
of you.
that.
So
Thank
definitely
you.
promote yourself away here so listeners know how they can learn more from you guys, because we're such fans of all three of you.
Yeah, it's funny. I kind of had this conversation with a couple of people this week, and I'm constantly changing how I describe the newsletter, which is probably a terrible thing. But it's all sort of in line with each other. But I think first and foremost, what I try to offer is, in terms of the value proposition, I try to return time to people, right? I want people to trust me that I'm reading as much news as possible. I spend all day on Bloomberg, Wall Street Journal, CNBC, Yahoo Finance, and I get dozens, if not hundreds, of research reports every day. Not that I'm reading all of those all day long, but I thumb through as much as I possibly can, and I also follow a couple of newsletters that do a very nice job of rounding up headlines. But yeah, what I try to do is go through all that and see what seems to be the most consequential, and sum it up for people so that they don't have to go out and have that same experience that I did. So in the 2 or 3 minutes you might spend with me in my weekly newsletter or newsletter that I publish during the week, I'm hoping that people realize that, well, that just saved me about 8 hours of my day.
What's the name of that newsletter?
It's called Ticker. It's spelled TKER. You can find it at tker.co. And if anyone listening, wants a couple of free months, just sign up for the free subscription, reply to it, and say, I heard you on the podcast. I want a couple of free months, and I'll shoot it your way.
The code could be Hattie Bees. The secret word is Hattie Bees, and then they get it. Give it to them free for a year.
There you go.
Reply
to the sign up email with Hattie Bees, and I'll toss you 3 months.
There you go.
And a
All right,
chicken.
so Paul, I mean, again, a huge fan of you and Justin for years. I love what you guys do. Tell us a little bit about Bespoke. I mean, what's Bespoke mean? And I kind of know, but why'd you come up with the name? I love the name, and go from there.
So, I mean, bespoke means, custom research tailored towards an individual's needs. And our focus is on taking the concept of a picture says 1,000 words and trying to show as much in pictures in a clear way that people can look at it quickly. Similar to what Sam was saying, the majority of our clients are advisors, and one of the pieces of the best feedback we ever get is when someone says, "Oh, I look at this in the morning, and I can call my clients and talk to them and sound like I'm telling them something different than what they're hearing on the mainstream news." So in that respect, they like that. And our research is, we try not to put our gut into it. We try and present the information as it is, but also give perspective on things, because so much you just get these headlines, and every day it's a new crisis in the financial markets. The media is talking about something different, and just say, hey, okay, all right, yeah, maybe it's a big deal today, but no one's going to remember this tomorrow. And today or this week was the 15th anniversary of Lehman going under. And just as a way to put that, if you bought the Friday before Lehman filed for bankruptcy, from that point to the low in March, the S&P was down 46%. So you'd look like a pretty big fool if you bought that Friday. But if you just did nothing and you held that Friday till today, your annualized return is 11%. So that sure as hell beats bonds, and it beats a lot of other things. And if you look at every crisis in the market, you look at the '87 crash, you look at the dot-com bust, you look at the financial crisis, you look at COVID. If you bought at the peak of each of those, not at the lows, at the peak, your returns are at least annualized 7%. That's based on the dot-com bust. But versus COVID, it's in the teens annualized and outperforming long-term treasuries over everyone. So we try and put things in perspective for clients and keep them on an even keel.
No, that's great. I mean, I think I first started hearing about you guys, reading about you. When were you in Barron's? When you guys were in Barron's, like 09, 08, it was a pretty splashy. When was that?
Yeah, so I mean,
that, right?
when early on, Copen and Tan, who used to write the Trader column, used to quote us all the time, and he took on a new role at Barron's, sadly, because it was first of all, he was great, and second of all, he quoted us all the time. But but then we had an interview in there, and that helped out. And I think just over time, people have just gotten to know us, and we're very non-promotional and just very.
What I want to say is, the first time I read your guys' stuff, maybe 08, maybe 09, around when you first started, I said, this is awesome. And I can't make guarantees, right? I don't know if compliance listening. You can't make guarantees, but I knew that you'd be successful. You and Justin, the stuff you're doing. Just like the two guys next to you, 15 years from now, we're going to be talking. You guys are going to be huge because the stuff you do is so special. So let's go to Frank for a minute now. Again, same question, but I want people to understand how Frank works here. Frank, you're at Instinet for how long? 20 years?
22 years.
22 years. So when I was unemployed, I was fired. I was unemployed. I was out there. I didn't know what I was going to do. Frank, I don't forget this stuff. You reached out to me. You were in Cincinnati. You hooked me up with some people in Cincinnati. I'll never forget that, So you're a good guy, you're smart, but you're genuine, and that is really, really special. Not that you guys aren't, but hey, maybe next time I get fired, I'll call you up and you can help me. But hopefully not anytime soon.
Don't call me.
But Frank, you're the real deal, man. And I really hope that you are wildly successful as well. And I know you will be. But I don't even know the question. Where am I going with this? Take it away.
Well, thanks, Ryan.
Yeah.
You did the same thing for me, so I appreciate you saying that. And so CappThesis, the name, so Cap. It's probably for Cappelleri. Cappelleri is fun to say, possible to spell. So that was it.
Our producers. We were like trying to find you on Twitter. And no one knows how to spell Cappelleri.
Yeah.
A lot of consonants, a lot of vowels. And so thesis is twofold. It's kind of funny, but I ended up majoring in English in college, kind of by accident. But it came to the fact that initially that I thought I could just write my way to an A at that point. But really, it was about supporting an opinion, and that's what thesis, of course, means. So, an opinion without something behind it is worthless. So that's what I've learned to do. So being at 25 years on Wall Street, I had a lot of different roles there, mostly as equity sales trader. So I started talking to buy-side traders. Then I got to writing much more content, started getting the content in front of buy-side traders, in addition, buy-side analysts, and then portfolio managers. So got a really good understanding of what the big institutions found valuable. And so just getting the press a number of times, got a lot of financial advisors reached out and asked if they can get it. No, you could not. And so as things went, it felt like
somehow you shared it with me. I don't know. Maybe we can say it now. I was on your distribution list, and I was not institutional.
Well, there's one reason actually to go back to that in a second. But you put so many great things out on Twitter for a long time, and for compliance reasons I didn't. But I reached out to you and said, "No, Ryan, I read a note out. It goes out to a few hundred clients. Would you mind if I use your information and cited you?" "No, go right ahead." And so, I wanted to send you some content as well, just individual, just to give a little payback there. So anyway, so CappThesis was born doing the same kind of content I've always done for institutions, but also knowing that clients want to see things at different times, and maybe a different report as well. So I put out daily commentary based on the major indices and trends, and also try to provide tactical trade ideas as well. So saving time, as I'm saying, for investors who like to look for patterns, like to look for mean reverting moves and that type of thing. So that's every day, and then on the weekend as well, I like to do a review as well as a preview from a longer term perspective as well.
Is it CappThesis.com, or what's the easiest way to find it?
CappThesis.com.
Okay. I mean, it's crazy, guys. We could do this all day, but we maybe have time for you question, me question, but let's do fast answers.
By the way, that's
I know
this
is
with
great.
2 P's?
So you get, exactly.
Yeah.
2 P's.
2 P's.
Right. Now, general question to everyone. So coming into this year, everyone is convinced that, or most people, not us, was convinced that, are we going to be in a recession? Maybe by Q2, but then it got pushed to Q3, and then it got pushed to Q4. Now a lot of people, maybe not everyone, seems convinced that, by next year we'll be in a recession. Now, Paul, you had mentioned something which was interesting, that, there are some signs that point to maybe, could we be early cycle here? I'm curious, let's just take the other side, whether you agree with it or not. Could there be some possibility that we are in an early cycle right now?
Well, so you just, one of the reports we put out, it's a matrix of economic indicators. It looks about 35 different indicators, shows their momentum, month over month momentum in their year over year readings. And last year, that was at recessionary levels. Every time since 1999 that it goes back, it was at those levels. We were in a recession. And then coming into this year, we're just in the last few months, we've hit levels that you have never seen near a recession. And the point is that, we may have been in a recession last year. I mean, the definition's always been 2 negative quarters of GDP. What did we have in the first half? 2 negative quarters of GDP. No one wants to call it a recession, but when Germany has 2 negative quarters of GDP, it's a recession. When France has 2 negative quarters of GDP, it's a recession. I don't know why it's not a recession here, but in that respect, I think we've seen some lows, and the manufacturing data is starting to at least plateau and show a little bit of improvement.
Yeah, I like what Paul brought up there about this whole matter of defining the recession. I don't know how to define a recession. We could be in a recession right now and call it a recession all you want. But from from an investor perspective, what matters is earnings, right? And so if earnings are holding up, we had a brief, earnings recession in the last couple of quarters, but things are turning up again, and expectations are for more earnings growth, down the road, and we're already at record level earnings for at least the S&P 500. So whether we're in an economic recession or not, again, there's probably some implications from a historical, history books standpoint, from a political standpoint, and all these things. But as long as job creation is positive and people are getting money in their pockets, it seems pretty bullish to me.
Makes sense.
And I would say it's all about the Fed, of course, and the Fed says they're data dependent. But I think they're more market dependent or price dependent, meaning that you're going to look at rates, and rates is going to define where they're going, and they're always behind the curve there. And so I think they've lucked out in the sense that the 10-year yield is basically flatlined for a year, so they could pause, not do much. But as we know, the bond market drives everything, and traders are going to end up pushing rates much higher than the Fed's going to continue to rise. But I think they're always going to be behind. And I think one way to look at this going forward is just commodity prices, right? Energy is one thing, but everything else, food and energy, so that's going to be very important, because that's really was the first thing we saw really start to move, right? A year before the actually Fed acted.
We're near the end, so one-word answer. We'll start with Frank, go down. New highs this year on the S&P before the end of the year, Frank. And then yes or no?
Yes.
Maybe. No, yes.
I was going to say maybe too, but I'll say yeah.
You got two
Yeah,
maybes.
I'm a yes as well. So, guys, this has been awesome. Let's do one more question. We want to go 40 minutes, maybe in 30 seconds. What is one timeless piece of investing advice that you can kind of leave some of the listeners on episode 52 of Facts versus Feelings, which we're going to call the Megapod? I think that's a good title for the
that's great.
So, timeless lesson. I'll start with Frank and go on down.
I would just say know your time frame and don't change. So you can either be a trader, short-term trader, or if you're a long-term trader, I think you have to be market agnostic, really.
Along those lines, your holding period, 1-day holding period, it's a coin flip. The longer you're willing to stick in it, the better. We call it the Montana rule. Is 16 years if your holding period is 16 years, market's never been down over a 16-year stretch or longer. So just time heals in the markets.
Yeah, I was going to say the same thing. Time in the market beats timing the market.
That's fair.
Final comments from you, then I'll bring us home.
No, thank you all for, everything, and your work especially. I mean, it's great to, I think Sam put it well when he said, your goal is to save time, and you've certainly saved me time. I know it saved you time as well, so it's nice to, get all of your research. I highly recommend it for everyone listening, and yeah.
No, I mean, we've quoted all of you on this podcast before, and we'll continue to do it. I mean,
Cool.
Research is awesome. Friendship is fun. The other last question, though. Sam, will you eat 2 pounds of chicken on Broadway later tonight or not? Over, under, 2 pounds. Yes or no?
That's a good question, Ryan.
Why not? Yes. What the heck, man?
Sure.
Why not? It's been
you
a
get
long
there,
week.
yeah.
Why? You've been in
Well,
California.
how
You've been all over.
they have different tiers of hotness. I don't know. I guess it depends on what I can.
Put it
stomach.
on Twitter.
Okay.
Follow your Twitter tonight. We'll see how it goes. But
I'll
everybody,
be live
thank you
tweeting
guys so much. This was
Thank you, guys.
awesome.
Thank
you very much.
We're gonna I guess live stream about to wrap up here. We did pretty good. We were about 40 minutes. This is episode 52 of Carson's Facts versus Feelings, live from Nashville at Excell Conference. The Megapod is in the books. Thanks everybody. See you next week.